In this video, I'm going to go over everything you need to know about establishing savings, and we're starting right now. Hey guys, Elliot here. So for this video, we're going to do part 2 of my online masterclass educational series. If you missed part 1, which is all about credit, there's a link in the description below that will bring you to that video. So grab a pen and paper, take some notes, and let's cover everything you need to know about establishing savings. As always, if you enjoyed this video and find it useful, please do subscribe to this channel. Helps me out a lot, and don't forget to smash that like button. Alright everybody, welcome to the Personal Finance Masterclass. This is part 2, establishing savings. It's made up of 4 sections titled Why and How to Save, Bank Savings Accounts, Money Market Accounts or MMAs, and Certificates of Deposit or CDs. Let's get started with section 1, Why and How to Save. So what exactly are savings? It's simply money that you set aside from your income and don't spend. Now it may seem obvious as to why you should have savings, but let's define this with some precision. The main reason to have savings is to establish a safe, rainy day fund for liquid access to cash in an event of a dire need, with the word liquid just meaning that you can get the money easily, such as going to an ATM to withdraw the cash right away or within a day or two in the worst case. The second reason to have savings is to avoid using expensive credit when you need cash. So for example, if your car repair bill is $800, you would be able to pay the mechanic in cash and not put it on your credit card with the 18% interest rate. Finally, if you invest, savings can come in handy if you see an attractive opportunity to invest in. Prices of investments go up and they go down, and if you have saved up cash laying around, you can acquire an investment when the prices are down. This can even apply to something mundane such as a sale on clothing or household items that you may need. If they are suddenly reduced in price, but only for a few days, having savings will enable you to purchase what you need at a steep discount. Now this is all pretty important, as not having adequate savings is a major nationwide problem. In one study, an estimated 40% of those surveyed said they would not be able to cover a $400 emergency without borrowing money. The bottom line is that establishing savings should be a top priority for any individual or family. It is important to point out that saving money does not equal investing money, and there is in fact a big difference. Savings currently earn very little interest but are held in guaranteed safe accounts that are protected by the FDIC, which I'll talk about shortly. Savings is really meant to just preserve your money. Investing can potentially earn you a lot more, but carries a risk of loss, and no investment is guaranteed by any agency. The intent of investing is to grow your money. So how much should you save on a weekly or monthly basis, and how should you do it? Well, how much depends on your income, whether or not you have debt, your living expenses, and the personal desire to save. The recommended minimum is to save 10% of your net income and all the way up to 25% if you're working in a higher income profession or you have no debt and moderate expenses. The best approach to saving is to deduct whatever percentage you decide on right after getting paid and transfer that money electronically to a savings account and forget it ever existed. This can of course be automated and is referred to as a forced savings plan. The next question would be how much to save in total. Here again, your personal needs dictate the exact amount. The typical recommendation is to have at least 2 months of living expenses in your account. That way you have a cushion if you lose your job or some other emergency happens. A more aggressive savings goal is 6 months worth of living expenses, as searching for a new job may take longer than 2 months or your expenses may be greater than you anticipated. Now you may ask, why not try to save even more? Well, here you have to balance the need to save money against the idea that if you put too much into savings, you aren't going to have cash left over to invest and gain from the benefits that real investing would bring. Remember that saving only preserves your money, and even that isn't as effective if inflation runs high. However, investing will grow your money and outpace inflation. This of course leads to the question, why not then invest all your savings? This is also not an ideal approach, as investing exposes you to potential loss of principal as well as volatility as the market goes up and down. You really want your emergency fund to stay put as it is and not diminish the week you need it most, and generally be protected in every way possible, including by the FDIC. The best approach is to really find that golden middle. This means figuring out your exact monthly living expenses and just decide how many months of cushion you need to put away to sleep well at night, no more and no less. So before we move on to section 2, be sure you understand everything just covered, including all the following terms, definitions, and concepts. Be sure to pause the video and define all of these and review the last section if you're not sure about any of them. Okay, this is section 2, bank savings accounts. The classic bank savings account should be familiar to just about everyone, and most people have a checking and a savings account paired up together. There are 2 flavors of savings accounts. The first is informally referred to as low yield. This is the basic level that you'll find at a brick and mortar bank or credit union. These savings accounts offer the lowest interest rates, which are currently averaging 0.06%. Some can go as low as 0.01%, but generally no higher than 0.1% at the time of this filming in early 2022. And this is all due to the extensive interest rate cuts in recent years. The second type of savings account is commonly referred to as high yield, and these are typically offered online only or through completely online banks. They sometimes require higher deposit amounts or put a limit on the number of transactions you can do, as well as other restrictions. Their interest rates can vary quite a bit, but will generally be significantly higher from 0.25% to 0.5%, which is certainly better than the rates offered by the low yield accounts. High yield savings accounts are essentially money market accounts or MMAs, and we'll discuss them in more detail in the next section. Both types of savings accounts are protected from loss by the FDIC. What is it exactly? Well, the FDIC is the Federal Deposit Insurance Corporation. It's a government agency that was formed in 1933 that protects depositors' money in case their bank goes out of business. The protection is currently at $250,000 per depositor per account. This basically means that if you have up to that amount on deposit with your bank and it becomes insolvent, you will receive every penny of that money back. The FDIC was and remains an important tool to stabilize the banking industry, and it's there to instill confidence in the U.S. banking system overall. Now, the FDIC is for banks only, but credit unions do have their own protective agency, and it's called the National Credit Union Administration, or the NCUA. It serves the same function as the FDIC, and all credit union accounts are protected in a similar way. To open a basic low-yield savings account, you just show up at your bank or credit union, present the relevant identification documents, and make an initial deposit. Keep an eye out for fees, with the main one being a monthly maintenance fee, which is typically assessed if the account is below a certain amount. There may also be transaction fees for withdrawals or transfers, to be sure to look for accounts that don't charge those, or at the very least understand what you need to do to avoid them. We'll discuss the money market account as a separate topic, and that is coming up in section 3. So before we move on to section 3, be sure you understand everything just covered, including all the following terms, definitions, and concepts. Be sure to pause the video and define all of these and review the last section if you're not sure about any of them. Alright, so this is section 3, money market accounts. So what exactly are MMAs? A money market account, or MMA, is a significant type of consumer bank account. It plays an important role in any savings effort and needs to be discussed separately. An MMA is essentially a high-yield savings account. The most obvious difference from a regular low-yield savings account is a significantly higher interest rate paid out, as well as some additional restrictions on depositors. Current rates as of early 2022 are averaging 0.5% to 0.6% nationwide. While this is still not a lot, it is roughly 10 times higher than a low-yield basic savings account. Given these higher rates, in most cases you should open up an MMA when considering a savings account and skip over the low-yield ones completely. So why do MMAs pay a higher interest rate versus low-yield savings? To understand the reason, you have to look at what the bank does with your deposited money. When you make a deposit into your neighborhood bank savings account, that money does not sit around waiting for you to withdraw it months later. It is immediately put to work earning interest for your bank as it lends that money out to other consumers. Fundamentally, this, along with those pesky bank fees, is how the bank's retail division covers costs and turns a profit. The loans made with your savings deposits are basic consumer products such as car loans and do not generally carry a high interest rate, therefore the bank won't pay much interest back to you for the use of your money. With an MMA, the money you deposit is invested, not loaned out, and typically earns a superior rate. The investments pursued by the bank include various government securities such as bonds, commercial paper, and other short and medium-term quality investments, including stocks. In addition, there are higher deposit requirements with some MMAs. This can range from $1,000 minimum all the way up to a $10,000 minimum. This ensures that the bank has bigger chunks of money to invest with, thereby yielding better returns. Finally, to goose the interest rates even higher, MMAs feature aggressive cost-cutting by limiting how much pricey activity is allowed on the account. With an MMA, you are typically limited in how many times you can withdraw or transfer funds or write checks against the funds. To save even more money, some banks have gone entirely online and give up brick-and-mortar locations except for some retail customer service outlets. Not surprisingly, these virtual locations offer the higher interest rates. To the consumers such as yourself, except for the higher interest rate paid, a money market account doesn't really appear a whole lot different from a regular bank savings account. Some bank savings accounts also restrict the number of activities on the account, and some also require minimums to be maintained to save on costs, so people are pretty used to this by now. Significantly, MMAs are also protected by the FDIC up to $250,000. Nearly every retail bank and credit union offers an MMA, and in this internet age, there are just as many, if not more, virtual banks. These online institutions are the same as the brick-and-mortar banks, and in some cases have even grown bigger and are subjected to the same FDIC protection, so there's generally little reason to be skeptical of them. Here's a listing of some of these virtual banks, and these are just for your information and no endorsement is applied. If you're curious who I personally have an MMA with, it's Sally Mae, but truthfully, any of the ones listed here would be a good choice. So when should you turn to a money market account? Well, the first reason was discussed earlier, and that is when you need a savings account for emergency use, and the MMA is the best interest rate available. There are also a few other reasons that may not be as obvious at first. For example, you may need a place to put a large amount of money from, say, an inheritance, insurance settlement, lottery winnings, or year-end bonus. You will likely have some use for that money eventually, but while you're deciding, an MMA is a great place to park it. It can also be used to briefly hold cash for something that will need to be paid out soon, such as a house down payment or a college tuition payment. In all cases, the advantage of an MMA is that it will protect your money from loss and at least somewhat from inflation. While you can certainly invest the money in stocks, but there is a chance of loss of principal. And you can certainly just place the money in a regular savings account, but the low interest rate won't come close to the rate of inflation. Only a money market account has features to counter both downsides, and it can be looked at as the best of both worlds. So when is a money market account not appropriate? The short answer is for long-term investing. Ultimately, as good as an MMA is, it's still at its core a savings account, not a true investing account. Your earned interest, especially in the low interest rate environment that we have now, is still very small, so it would not be appropriate to recommend this account for any sort of growth investing or retirement planning. Also, do not use this type of account if you plan on performing numerous withdrawals in a short time span or move money around frequently, as the fees will eat into your earnings. You can open an MMA account in person or more conveniently online with any bank. With virtual banks, of course, online is the only way to go. Be prepared to have identification in either cash or checks to deposit, or an account number from which to transfer the deposits from. Now, when you're deciding which bank to open an MMA with, be sure to consider these 4 items. Number 1 are the competitive rates of return. The interest rate will of course vary from year to year and from month to month, so just compare between banks. It will then become clear what a good rate is for comparison purposes. Number 2 are competitive deposit amounts. You would like to have the option to deposit moderate sums as well as large amounts. If you needed to deposit a minimum of $10,000 at a certain bank to earn the best rate and you only have $5,000, then keep looking. The minimum deposits vary widely from bank to bank. Number 3 are low fees. Every type of account has the potential for fees. Many kick in if your balance goes below the minimum deposit requirements or or if you withdraw too many times. If you can avoid both scenarios, you should be okay, but read all the fine print. Number 4 are the other benefits. In some cases, you may like other benefits these banks offer, such as check writing abilities or a link from your MMA to a savings or checking account. Make sure the bank can provide whatever it is that is important to you. So before we move on to section 4, be sure you understand everything just covered, including all the following terms, definitions, and concepts. Be sure to pause the video and define all of these and review the last section if you're not sure about any of them. So here we are, section 4, certificates of deposit. So what exactly are CDs? Certificates of deposit are commonly used savings instruments and are offered by nearly every bank and credit union. CDs are not your typical savings accounts per se. You cannot, for example, deposit and withdraw from them on a regular basis. Rather, they're just chunks of money that you give to the bank for a predetermined length of time in exchange for earning interest. The amounts you deposit into a CD are typically larger blocks of $500, $1,000, $5,000, or $10,000, but smaller and much larger CDs do exist as well. Some institutions accept a deposit as small as $250 on the low end and as much as $1 million on the upper end, so it just depends on the bank or credit union. CDs are called time deposit accounts and come with a deposit term, which can vary widely from 1 month all the way up to 60 months or longer. During that time frame, you cannot withdraw the deposited amount without incurring a financial penalty. So what can you earn with CDs? Well, they pay roughly what a money market account pays, but in some cases it can be significantly more. The biggest factor that determines how much interest you get paid is how long you're willing to keep the deposited amount in the CD. By tying up your money longer, the bank is free to invest it without the risk of having to give it back on demand, so the longer term CDs will pay out a lot more than the short term CDs. What are the banks actually paying for? Well, when you give them your money, you lose the ability to invest the money elsewhere, so a higher interest rate is paid out for you for that opportunity loss. Looking at it another way, you're forfeiting liquidity or the ability to access your money in exchange for a higher return. Just like with money market accounts, with all else being equal, you will find higher rates will be with the online only institutions. So with all that said, how much interest can you earn with CDs? Well, here are the current averages for interest rates being paid nationwide, and as you can see, you'll earn a lot more if you're willing to not touch the money for 3 to 5 years as opposed to the short term 6 months to a year. So when is opening a CD appropriate? They are a great place to park cash for a fixed amount of time and have both FDIC protection for the principal and a decent rate of return, or as good as it can be in this ultra low interest rate environment. It's important to understand that CDs are best for long-term savers, and that's really the bottom line on CDs. If you don't need the money soon, you can earn a lot more. When is CDs not appropriate? Just like with MMAs, the short answer is for long-term investing. Ultimately, as good as CDs are, they're still instruments for saving and not true investing. Your earned interest, especially in this low interest environment, is still very small, so it would not be appropriate to recommend this account for any sort of growth investment or retirement planning. Also, do not use CDs if you need the money in less than 12 months or you need to occasionally withdraw and deposit funds, as you can't really do that with a CD. Once it's in the bank, that's pretty much it until it matures. For a more liquid account or for shorter term saving, use an MMA, as CDs really reward those looking to put away their money for 1 to 5 years. Certificates of deposit come in a few other flavors and versions aside from the basic type, which is incidentally referred to as the traditional CD. Some of the better known ones are listed next, but there are others as well. The first type you should know about is the no penalty, or as it's sometimes called, the liquid CD. As you can probably guess, these are CDs that can be redeemed before maturity, but at a cost of a lower initial interest rate. It's appropriate only if you aren't sure if you can wait out the term of the CD, but still want to open one up. The second type is the bump up or raise your rate CD. This type of CD allows you to switch or bump up from a lower interest rate CD to a higher interest rate CD if the prevailing rates rise enough. The cost for that privilege is a lower initial interest rate to start with. It's a bad gamble if you think that rates will rise, but they don't, and it's a good gamble, of course, if the opposite happens. The third type is the brokered CD. This interesting variation operation is sort of like a mutual fund. You buy into a large CD purchase with many other investors through a broker, and then you own a fraction of that CD. This avoids penalties if you want to withdraw, as the broker can usually sell your investment share to someone else. The main benefit, however, is the higher interest rate, as the pooled money allows purchase of what are called jumbo CDs, and these are typically over $100,000, and they pay a higher interest rate that gets passed along to you. Finally, there's the zero coupon CD. These are much like zero coupon bonds. The CDs are purchased at discounted or face value and make no interest payments. You redeem the CD for the full face value for a profit. The next topic to briefly discuss is the CD ladder. A certificate of deposit ladder is simply a technique where you purchase numerous CDs at predetermined intervals but of similar maturity dates. They then mature at regular intervals, giving you more liquidity to access cash or the ability to reinvest at a higher interest rate in a rising rate environment. They resemble steps in a ladder, hence the name. What would that look like in practice? To make the math simple, let's say you have $12,000 to work with. You can then purchase a 3-year $2,000 CD every 6 months, taking 3 years to deposit all the money. Just as you're done, the first $2,000 CD matures. You can then either redeposit it at a higher interest rate or use the cash if you need it. You never have the full amount tied up in one lump sum, and the staggered maturity dates give you a lot of flexibility in how to use the money and plenty of chances to redeposit in something else while still getting the benefits and protection of a CD in the first place. Finally, we will conclude the discussion on CDs by mentioning how to open them. Certificates of deposit are offered by nearly every bank, credit union, and even brokerage houses in some cases. You should first do some research and find the best rates, then head to your local bank or credit union branch or to the website of an online bank to actually purchase one. The process isn't too different from opening a savings account, and you will have to provide the same basic personal information and credentials. You will then transfer in or deposit funds, and the bank will ask what type of CDs you want to open, the terms you're choosing, and the amount you are depositing. You will then get an online account portal where you can see your deposited money and the appropriate interest payment added to your balance. When the term is up, you can then withdraw or redeposit the money, which the bank may likely encourage you to do. Okay, let's go ahead and review section 4, including all of the following terms and definitions. Be sure to pause the video and define all of these to yourself, and review the last section if you're not sure about any of them. Alright, so this is the end of the Understanding Savings Masterclass. I hope you enjoyed this video and got a lot out of it. If you did, please do consider subscribing to this channel and turning on notifications so you don't miss any of the upcoming financial and investing videos just like this one. Thanks for watching, and I'll see you all soon.